Home Depot is one of the biggest profiteers of a housing boom. Their revenue has just skyrocketed. And of course now with a housing crisis and the interest rates, not as many people are renovating anymore and revenue has slightly declined. And while net income is still down, their free cash flow is already back into growth mode. So let's try to find out today if the stock is now a buy. Overall, we can see net sales are down by around 3%. But of course, their segment right now is kinda in a downturn, so it is not a complete collapse. Customer transactions down by 2.4%. Average price of these transactions slight decline by 0.3%. Comparable sales, which is sales per retail square foot, is down 3.7%. So overall, we can see not everything is gloomy at the company, but it is to be expected. It is just in a downturn, but the reduced amount of transactions and the reduced sales per retail square foot have many reasons. One, of course, the higher interest rates, which lead to a housing downturn, which leads to less renovations, but also that deflation is hitting this company. Sadly, not all of these are included in the CPI, but we can see in the tools and hardware section, which is a part of Home Depot, actually deflation is hitting the segment. And with that in mind, this little decline here is actually fairly good. It means the company is strongly positioned. You should monitor these things. If they decline further, then it should ring your alarm bells. But right now, it is still okay. Especially because it has already been worse before. In Q1, it was down by 4.8% the amount of transactions, and sales per square meter are down by 4.7%. So overall, when we look at year-over-year data, I think we have kind of reached the bottom. So if it declines, it won't decline much further. Most importantly, they're still buying back shares. They bought back 2.3% of the shares outstanding. They're now below 1 billion shares. Home Depot has historically been a company that buys back shares. Their share count continuously goes down and down and down and down and down. They usually buy between 5 to 2% of shares back. Currently they're buying around 2.3, not too bad. They did this while amassing a lot of debt, but we can see long-term debt year over year is down. They're starting to pay back debt. And at the same time, they're re-accelerating their repurchase program. They increased it by 1.3 billion. And they're also increasing dividends. So while they're reducing debt now, they're also managing increased stock repurchases and pay out more of a dividend. So they're not aggressively buying back shares right now. I think in the future they will do that more. They will take on more debt. But right now, I like it that they're more conservative. The company is in a downturn right now, so don't leverage up to buy back your own shares or pay it out as dividend. And their debt is not too concerning yet. Yes, their net debt is currently at 47 billion, but they make around 17 billion in free cash flow right now. Their debt is not risky at all. Even if it goes back to the 2019 levels, which were also kind of a down levels of 2022, 10 billion per year in free cash flow, that is less than 5 times their debt. So that debt is not really a risk. One thing I often hear about stocks like Home Depot though, is that they just reach their maximum growth amount. That they have so many stores, they cannot grow any. We can see they have a lot of stores in the US, but they're still opening some. And even when it comes to their only 2 countries where they operate internationally in, Canada and Mexico, the state of Texas has more stores than the entire country of Mexico. There is still huge growth potential here. And they're still opening stores in the US. During the 3rd quarter alone, they opened 5 new stores and 2 in Mexico. No stores were closed. So the stores they have are not struggling. And they can easily still expand into other international markets. Europe, Asia, South America. All of these countries do not have companies that are as big as Home Depot. Home Depot got into Canada via an acquisition and it has massively paid off. I can see them doing the same in Europe. For example, here in Germany, we have one big company that is like Home Depot. Their market cap is around 1.5 billion. That would be an easy acquisition and they would be in all of Europe all of a sudden. I'm not saying they should do this or that it would be a good idea. I'm just saying, even if they're not growing as fast in the US anymore, despite them still growing store-wise, they still have much room to grow. And even if they don't grow that much anymore, Home Depot is good at growing one thing, its margins. In 2014, their free cash flow margin was 8%, and they continuously increase it. The only time it really fell where the big downturn was for them, but it's already recovering. It's already above pre-pandemic levels at 11%. They increased their margins from 8% to 11.5%. That may not sound like a much, but 3% extra margin on free cash flow is a lot. And at the same time, while other retailers are struggling right now because of things like theft, here Home Depot has an advantage. Theft is not as bad when it comes to Home Depot when it comes to other stores like Walmart, Best Buy, Ulta Beauty. All of these things, people easily steal there. They go in, take the lipstick they want, or they go in as a group and steal a bunch of iPhones. That happens regularly. But it is very uncommon for a bunch of thieves to go into a Home Depot and steal some expensive equipment there. Yes, it happens, but it is not as regular. It is just not as attractive to thieves to steal a giant chainsaw instead of going to Best Buy and just snatching the next iPhone. Historically, Home Depot had between 5 to 7% in revenue growth. and 2 to 4% in buybacks, plus a slight margin improvement over time, which you cannot forget, it is crucial. Since 2014, even if they wouldn't have had a change in revenue and in the shares outstanding, they would have grown free cash flow by 37.5%. That is huge, just in margin change. So if we're on a conservative side here and say 8% for the next 5 years, 7% afterwards, 18 multiple, 50% payout ratio with a little deduction due to taxes, we come to 295 a share. Nearly the current value. So on the stock we would get around a 9.5% return right now, with our conservative assumptions, which I find okay. Now what if it goes a bit better? Slightly higher growth, slightly higher multiple. Well, then we would come to 335 a share. And what if it goes worse? Maybe growth goes to maybe 2 to 3% per year and just the buybacks are gonna increase it more. No margin improvement. 6% for the next 5 years, 5% afterwards. Well, it would be 221 a share. Home Depot is a great stock right now. It is not overpriced really, and I would get a nearly 10% return with my conservative assumptions. I'm not gonna buy it yet. I have other stocks which are more underpriced in my opinion right now, but I'm definitely putting it on my watch list. It is a fantastic stock, and if the stock goes down a bit more, I think I would be willing to add it to my portfolio. What do you think about Home Depot? Write it down below. Have a good day.